Welcome back, everyone. Look, if you're gunning for that top-tier A-star grade in IGCSE Accounting 0452, you are in exactly the right place. I'm your subject specialist.
And I'm a senior examiner. Today's explainer is a seriously high-energy masterclass on Module 2, the role of accounting in decision-making. We are taking you all the way from basic data entry to outright boardroom financial survival. Let's get right into it.
So, here's the real A-star secret. It is not just about having flawless math, right? It's really about unlocking those crucial method marks and bridging the gap from just, rote memorization to actual boardroom level evaluation. To secure those top marks, you've got to prove you can think like a chief financial officer. You need to analyze the why and the how behind every single transaction, not just punch numbers into a calculator.
All right, quick look at our roadmap for today. We're hitting the A-star conceptual foundation, then technical execution and method marks. After that, AO3 ratios and evaluation, a cool modern fintech application, and finally, my absolute favorite, examiner insights and pitfalls.
Jumping right into Part 1, the A-star conceptual foundation. Listen closely to this one, because for the syllabus 2028 to 2030 updates, Cambridge strictly mandates using modern international terminology. If you use outdated terms instead of irrecoverable debts or owner's equity, it will instantly cost you marks. No exceptions.
Exactly. When you're dealing with those complex, multi-layered business scenarios in Paper 2, using the exact mandated vocabulary, we're talking terms like accrued, prepaid, and realization. That's literally your first step to proving you belong in the top percentile.
And your core logic has to constantly anchor back to the ALE memory hack. Assets equals liabilities plus equity. It's that simple. This accounting equation absolutely has to be maintained throughout the entire fiscal period. It's all driven by the duality of every transaction and the business entity concept. But hey, pay super close attention to the prudence concept. Do not, under any circumstances, overstate profits by ignoring potential losses. Doing that completely violates the integrity that interested parties like banks, owners, and tax authorities rely on. Basically, never artificially inflate the success of the business. Moving on to Part 2, technical execution and method marks. Okay, so the vital procedural flow here moves from source documents, like an invoice or a bank statement, straight to books of prime entry, then T accounts, trial balance, and finally your financial statements. Applying an advanced technical methodology here is your ultimate safety net.
Spot on. You absolutely must show all your workings to secure those method marks. Whether you're adjusting for depreciation, doing an inventory valuation, or correcting errors, making your step-by-step logic totally visible guarantees you marks. Literally, even if your final balance is completely wrong, showing the logic saves you.
Now, mastering the T-count structure is really the gold standard of the double entry system, but you have to distinguish perfectly between balance B/D, which is your balance brought down to start the new period, and balance C/D, the balance carried down at the end.
Candidates constantly mix up these two critical balance indicators. As an examiner, I can promise you that confusing a starting balance with an ending balance will absolutely derail your entire trial balance phase. It's a disaster.
You also need to clearly separate your discounts to avoid some really painful mathematical miscalculations. Remember, trade discounts are for bulk buying, and they are never recorded in the double entry system. Cash discounts, on the other hand, well, they're rewards for prompt payment and absolutely must be entered in the books. Oh, and one last technical tip for absolute perfection. When you're working on manufacturing accounts, do not forget your state symbols. I can't stress this enough. These tiny, meticulous details signal to the examiner that you are a high-caliber candidate who really knows their stuff.
Let's pivot to Part 3, AO3 ratios and evaluation.
Take a look at this. Notice how the current ratio drops from 2.5 to 1 in year 1, all the way down to a pretty precarious 1.1 to 1 in year 2. Now, anyone can calculate this drop. The math is easy. But an A-star candidate, you've got to ask the big question, why is this business suddenly struggling so hard to cover its short-term debts? Right, and to answer that, you need a direct cause and effect chain. Has inventory been massively overpurchased, which is tying up all the liquid assets? Or, are trade payables being settled way too slowly, which damages supplier relationships? Or perhaps cash reserves were just completely depleted by a massive sudden capital expenditure.
Exactly! Moving beyond just the surface symptom to actually diagnose the underlying financial disease is exactly how you ace those high-level AO3 investigative questions.
Now,
Inter-firm comparisons can be really dangerous because businesses often use entirely different accounting policies. Think straight line versus reducing balance depreciation. It's like comparing apples and oranges. You really have to look beyond the surface numbers and analyze the actual quality of the profit. And furthermore, you must evaluate non-financial factors. Things like staff morale, business location, and market reputation, well, they aren't captured in the ledgers anywhere, but they are absolutely vital for a business's long-term sustainability.
All right, on to part 4, the modern fintech application. Let's consider a modern fintech case study for a second. Think about AI-driven accounting software like Xero. Today, this software completely automates the procedural data entry. The books of prime entry handled entirely by algorithms.
But here is the absolutely crucial takeaway. These systems rely entirely on human logic for evaluation. Sure, AI can calculate the current ratio in a millisecond, but it takes a human business analyst, equipped with these exact AO3 evaluation skills we're talking about, to determine why that ratio dropped and what strategic decision the owner should actually make next.
And finally, part 5, examiner insights and pitfalls. Let's get into the vault.
Okay, here are these strict rules that truly separate the A-star students from everyone else. First, a major warning from the grading room. Candidates are actually losing marks simply through poor handwriting in ledger accounts. I am not kidding. If I cannot read your numbers or your B, D, and CD notations, you lose the mark, period. Second, failing to explicitly distinguish between capital and revenue expenditure will completely distort your financial statements.
That practical application is just so important. When you're documenting evidence for coursework or answering practical questions, strict separation of those items is totally non-negotiable. And please watch your time management. Pay close attention to the weightage of each question part so you don't accidentally spend 20 minutes agonizing over a simple 3-mark calculation.
As we wrap up, we're leaving you with a pause and think A-star challenge. If a business deliberately changes its depreciation methods mid-year specifically to inflate its reported profit, are they violently breaking the prudence concept or consistency? Ponder how those concepts overlap to protect the integrity of financial reporting. Keep reviewing your cause and effect chains, hyper-focus on your method marks, and you will absolutely crush this exam. See you next time on The Explainer.